You found a great deal. Now it's time to finance that deal. So here are some financing strategies for multifamily real estate. So some traditional options. If you're doing a 2 to 4 unit property, you'll get the same kind of loan that you get if you're buying a personal residence. You get a 30-year fixed rate mortgage. So the length of the loan is 30 years. The interest rate stays fixed for 30 years. So you don't have to deal with the fluctuations in interest rates up and down. Once you get over four, you're looking at a commercial loan. So this is 5+ units. Traditionally, it'll be a 20-year length, but only 5 years will be fixed. And at the end of 5 years, you'll basically have to either refinance or sell that property. Um, and then the last one for larger properties, you can get some agency debt. So this would be for Fannie and Freddie Mac. These are government programs that are for purchasing larger properties, traditionally $1 million and up. They're non-recourse, so they can't come after you if something happens to your loan. They can't come after you personally. And they're generally favorable terms, and they can be up to 30 years as well. Some other financing options, you can have seller financing. This is basically when the seller or owner agrees to do financing themselves. Maybe they paid off the property and there's no debt owned, and they just basically want to be the bank and collect payments. These is great because you can do, really structure a win-win on both sides. You can negotiate any sort of terms that you want. So seller financing is a great option if you can find an owner that's motivated and you can sell them on taking that financing. Lease options is another way if you're lease the property for a small portion of time and then have the option to buy it. So this gives you some flexibility to build up down payment, and then you can lock in a purchase price down the road that you have the option to buy if you want to. Private and hard money. Private money is basically people that that are willing to lend you money. Generally, you can get good terms on this because you're just trying to get a return from them, and they're generally pretty flexible. Hard money be a little bit less flexible on the terms. This is basically from people that are loaning on all the time, but this is short-term loans, high interest, expensive, but just kind of get you out of a pinch. Or if you're doing a big rehab project, you can take on hard money at first and then refinance once the value is added into like a long-term fixed rate loan. Bridge loan is kind of the same thing, but just for larger projects, you're taking on short-term loan just to get you to long-term financing once it's stabilized after you do your renovations. Those are short-term as well, 12, 24 months, that kind of thing. Subject to, with interest rates high right now, subject to might be a good option. You basically take over the payments for the mortgage without actually taking the mortgage into your name from the seller. So this might allow you to get into, payments that are lower at a lower interest rate, maybe 4% instead of 7 or 8%. But then you just got to be careful with this because if the lender calls it due, that owner might be forced to pay off that mortgage right away if they kind of find out that you're doing that. You could use a home equity line of credit or line of credit to fund some of your deals. So if you have a bunch of equity built up in your personal residence or another property, you can get a line of credit for that amount and then use that as your down payment or your purchase, your funds to purchase the property. Partnerships I've done a bunch of times, which are really great as well. You can, if you're somebody that's looking for money and can't really find the funding, you can do a lot of the work, do the hard part of finding the deal, managing the deal, that kind of stuff. You can partner with somebody that maybe has a lot of the capital that can bring the capital side of things and do more of that. So you're partnering with somebody that has the money, so you might not have to bring a whole bunch of money to the table, but you're adding value to them by managing the deal, running the deal, finding the deal, that kind of stuff. So partnerships are really great. You offer them a percentage, you get a percentage, but you both get to take down a great deal. So just some key loan terms. If you're looking at loans and you're not familiar, loan to value is basically how much the loan on the value of the property. So if you buy a property for $100,000, most of the loans will be for investment properties will be 75% loan to value. So they'll offer you a loan for $75,000. You got to come up with other 25 plus any closing costs. Amortization is just how long they spread the payments out. So if a loan is amortized for 30 years, the payments will be less than if they're amortized for 20 years. Term is actually the length of that loan. So like a commercial loan, it will be amortized for 20 years. The spread kind of make the payments less, but then the term would be 5 years. So then at the end of 5 years, you got to refinance that loan into a new loan or just sell that property and pay off the rest of the loan. Interest rate's pretty obvious. It's the lower the interest rate you can get, the better. This is basically determines how high your payment is, and this can vary a ton from where we used to be at 3 to 4% to currently where we're at in 2024 at like 7%. Really change your payment, which changes everything about the property. As far as return, fixed and variable, you can get take on a little bit extra risk, get a little bit lower rate. Sometimes take on a variable loan, so the rate of interest can change with the market. So if you're really confident in where the market's going to be, maybe it's worth the risk. But traditionally, it's better to go with fixed rate because then you can kind of outlast any sort of bad market conditions. They do also offer interest-only loans for some of these loans, which is a good option because you're not paying any principal. So if you're need some extra cash flow at the beginning, or you just need lower payments at the beginning because you're adding a bunch of value, interest only can work great because that you're only paying the interest, which significantly reduces the mortgage payment each month. Balloon payment is just basically when the loan comes due. We did seller financing for one property with a balloon payment at 2 years. So we paid payments for 2 years, and then at the end of 2 years, basically the balance of that loan was due, or the balloon payment for that property was due at the end of 2 years. So we had to come up with $80,000, I think it was, for that property. So what we did, we refinanced it after we had added all that value. The money that we got from that new loan paid off that old loan's balloon payment. And then the last thing, debt service credit ratio. It's key to know this is how the bank determines, or the lender determines, how well the property is going to perform and how likely it is to service its debt. So you take your income minus all your expenses. That gives you your net operating income, and then you divide that by the annual mortgage payment, and this will give you a number of how likely you are to basically cover your mortgage payment. The banks traditionally look at 1.25 is that number. Anything above that, the higher you go above that, the more likely you are to not default on your loan. So they're basically looking for your income from the property after the expenses are paid is going to be 125% of what your annual mortgage is. And this just basically helps them determine, that the property is going to be paid and there's not going to be any issues with defaults. So those are the traditional financing options. Throw me on the next one.